Jay Fagan here with the Mattox Group and another update on OB3, the new tax bill effective July 4th, 2025, called House Resolution 1, HR 1, or the One Big Beautiful Bill Act. We call it, of course, OB3. In today's update, we're bringing to you some information on the new overtime deduction, who qualifies for it, how it may apply to you, and what the impact might be on your income tax return. So this is a new deduction for tax year 2025 through tax year 2028 for tax years, limited time limit as a number of these provisions have been. So income earned from January 1st, 2025 all the way through December 31st, 2028, each respective tax year, of course. And the deduction is limited to $12,500 for single and head household filers and $25,000 for eligible joint filers. Once again, this is another provision that married filers who file separately, married couples who file separately, are not going to be eligible for this particular deduction. Same as the overtime, the auto loan interest, the senior deduction. So OB3 put in some penalties for not filing joint returns, and this is one of them. The overtime, of course, has to be eligible. And on that filing, a number of these provisions that were codified in OB3 require a Social Security number. This is one of them. So you must have Social Security numbers for eligible taxpayers on the return. You will not be able to paper file without a Social Security number and claim this deduction and get it to stand. So $12,500, $25,000 maximum deduction for qualified overtime. What is qualified overtime? There are some limitations here. Two primary, a dollar cap and the income phase out, which we'll talk a minute. The other, of course, is that the overtime must follow under Section 7 of the Fair Labor Standards Act. So it has to be generally recognized qualified overtime. That's over 40 hours in a standard work week. So in states like California, where we have different overtime rules, where overtime kicks in for every hour over 8 hours worked in the day for eligible employees, and every hour over 12 hours, double time comes into play, and then additional overtime for hours over 40 in a week. Those state-specific rules don't apply. This is a federal income tax deduction, not a state deduction. So the federal Fair Labor Standards apply. Union contracts can still apply if they meet the requirements of the Fair Labor Standards. So a non-standard work week may not be able to apply, and there's some other regulations that we're looking to see clarity when the final rules come out on this for exactly what a standard work week will ultimately end up being for this purpose. Section 7 is fairly broad, so we'll see how the IRS determines how to interpret that. It has to be reported on a W-2 or a 1099. The IRS, just like with the overtime deduction, has indicated there will not be a new W-2 this year. So we're not quite sure how that's going to shake out with reporting in 2025. So stay tuned. There should be more information on that, and when we have it, we'll push that out. But it does need to be reported on a proper W-2 or 1099 payroll form. There does seem to be some confusion or disagreement online about whether or not 1099 reporting will work. The way the law is written, it will, but there does seem to be some consternation among the different reference sources as to whether or not independent contractors are going to qualify for this deduction. It does appear that they will. If we hear definitive information once the regulations are posted one way or the other, of course we will let you know. But at the moment, we're going to assume that qualified overtime for hourly employees, wage earning employees, are going to qualify, and a statutory employee is one of those that might receive a 1099 or a W-2 marked as a statutory employee. So we'll see. Their reporting is still a little up in the air on this one. But by and large, you have to be a non-exempt employee, an hourly employee who's subject to overtime. So when we look at the way the deduction works, as we said, it's dollar cap, $12,500, $25,000. There is an income phase out, $150,000 for single and head of household filers, and $300,000 for joint filers. Again, married filing joint. And that's not the elimination threshold, that's where the maximum deduction begins to phase out. And of course, it phases out in full at 300,000 and 550,000. 300,000 for single filers and 550,000 for joint filers if both taxpayers were eligible. The threshold would be lower if only one taxpayer was eligible. And it phases out at about 10% of the amount over the threshold. So that just work the math on where that comes into play. Again, we're looking to see exactly how this will be reported for 2025. So pay attention to that. And if you're at all concerned about how it's going to be reported, make sure you're documenting in your own records the overtime you work, the eligible overtime, and ensure that it's reported to your tax professional at the end of the year. I do just want to reiterate that if you're under a contract or a state law that provides overtime that's not qualified by the Fair Labor Standards Act, it's not going to qualify for the federal deduction. Certain collective bargaining agreements might not be deductible, particularly if they exceed those FLSA's requirements. So let's talk about what this looks like in an actual tax return. And our taxpayers in this example are going to be a married couple with 2 children, and they're making $225,000 a year living here in California. So we have a state tax as well as a federal tax. Now, prior to the bill, they're just married filing joint, adjusted gross income, no adjustments there, no changes. They will, of course, qualify for the child tax credit for each of the kiddos that they're eligible for, but no other itemization, standard deduction filer in this scenario, just straight across the board. I want to illustrate the impact of this particular deduction. So if we look at their overall income tax liability prior to the deduction at that $225,000 a year in adjusted gross income, $31,500 is the standard deduction for this year. Just to reiterate, of course, like the overtime, like the tipped income deduction, the overtime deduction is also stackable against the standard deduction. Itemized filers and standard filers are able to claim it, and they get both. So before the overtime deduction, this couple would be paying 12.44%, just under 12.5% effective income tax rate for federal purposes, and just under 5% for state purposes, state of California, 4.92 in our scenario. So a combined effective tax rate of 17.37%. That means just over 17 cents on every dollar they took in would be paid out in federal and state income taxes combined. Effective tax rate versus marginal. If you followed our video series, we've talked about this a little before, but marginal reflects the various brackets, 10, 12, 22% of the federal level, 1 through 13.3% at the state of California level. States that don't have income tax brackets, of course, that doesn't apply. But those percentages reflect an amount of money within the bucket for each of those income tax brackets, progressive tax. And so in our taxpayers scenario here, their marginal tax bracket is going to be in the 22 or 24% bracket effectively because a portion of their income would have fallen into those respective brackets depending on their filing status. However, their effective tax bracket is the dollars that they actual paid, real dollars in taxes against their total income. So you get a good apples to apples comparison of what your tax liability actually is, not what the highest marginal bracket, a portion of your income would have fallen into. It's very important in a progressive tax system to be aware of your effective tax rate. As an aside, I just want to note when you're looking at your withholdings every year on your pay stub and at the year end on your W-2, and you're either owing at the year end or you're getting a larger than expected refund and really a larger than desired refund, because why give the government an interest-free loan? It's that effective percentage that you need to be paying attention to, because the withholding on W-2 employees is set up against those tax brackets, and it's generally a fixed percentage. But if your effective rate is lower than that rate, then you're going to have a refund because you're over withholding. And if your effective rate is higher than that withholding rate, you're under withholding and you need to add some additional income tax withholding per pay period in order to get to break even. That's a calculation we work through with our clients. We encourage you to work through it with your tax advisor. If you don't have a tax advisor, we're always taking on new qualified clients here at the Mattox Group, so don't hesitate to reach out to us if you find yourself in that situation. So, and again, back to our couple, $225,000, California, married joint, 2 kiddos, just over 17% effective income tax rate combined before the qualified overtime deduction. So let's see what happens when we take that deduction. Okay, so our couple has the full $25,000 of eligible overtime deduction in play here because their adjusted gross income was under the $300,000 level. So we take that $225,000 gross income, reduce it by $25,000 to get to a $200,000 adjusted gross income by claiming that full overtime deduction. We then take the standard deduction, which is $31,500. So their taxable income now drops down to $168,500. And again, remember their income tax was just a little over 17% combined earlier. Well, now their federal has dropped all the way down to 10%. And their state has dropped down to just under 3.89%. So that total effective, which was just over 17, is now just under 14%, 13.89%. So a $25,000 stackable deduction has a pretty significant impact, a really measurable impact on our taxpayers, roughly 4 cents on the dollar, which isn't the necessarily a huge amount of money depending on the taxpayer, but it's also not something I would say no to either. So that's what it looks like in this particular scenario. Everyone's scenario is different. We're always happy to run through your particular numbers, but we do have this new overtime deduction for eligible employees on eligible overtime starting this year, 2025, all the way through 2028. And I think it's going to be difficult for a number of filers here in a high cost of living, high wage state to necessarily benefit from, but those are pretty broad adjusted gross income brackets. I think as long as this, I personally believe as long as this is reported fairly and accurately, a number of taxpayers are going to be taking advantage of this deduction. And anytime we can provide a deduction that helps out working families, helps out, single parents with children, or just hustling young professionals out there trying to make it, I'm personally in favor of that. So that's the update for OB3 on the overtime deduction. Again, more to come on these particular regulations around the what's qualified eligible overtime and how this will impact certain contracts, particularly unions. As we get that information, we'll push it out. Stay tuned. Pay attention here to our social pages and our newsletter updates with our clients. If you're not one of our clients, again, we're always welcoming new qualified people who need an advisor in their corner here at the Mattox Group. So don't hesitate to reach out, and we're happy to talk about your particular situation, how we might be of value to you, and welcome you aboard. Thanks so much for listening. Talk again soon.